I've been looking forward to getting a chance to talk to Martin Pelletier. He's a senior portfolio manager at Wellington Altus Private Counsel. Martin, appreciate you taking the time. And I got to say this up front. People can find you on Twitter, Martin Pelletier, of course. But man, I love the stuff you put out there. It's such a great perspective from a long career, first as an analyst and now as an advisor and that kind of stuff. So I just think it's sorely missed in this economy or in this kind of environment that we're dealing with. So let me just start with the Barbara Walters in me and ask you, what worries you most for individuals in the environment we're in?
I think people they have their head in the sand about the state of the broader economy and the consequences of that and their exposure from a risk standpoint, thinking that we're going to go back to the way things were pre-COVID. And COVID was a structural change. And whenever there's a big structural shift or a structural change, we don't go back to the way things were. And so maybe it's a hybrid, or maybe, it's something that looks a little bit like it was before, but we really don't know. And so that means with that heightened level of uncertainty, you have to take a look at what areas that you are potentially exposed and what areas that your kids are potentially exposed, and start to plan accordingly. And the best time to buy insurance is when it's cheap and you're healthy. And and things are good, and things are still not too bad. And so, why not add a little bit of insurance into your life by changing a few things?
What about exposure right now? I mean, obviously, at least I'm worried about global debt, country debt, individual debt, and obviously when we've had this big bounce in interest rates, we've seen it play out in things like banks' treasury portfolios are dramatically declined, whether it's in the UK pension funds or, more recently with Silicon Valley Bank. It's a similar story. Are you worried about further disruptions that way into the broad-based economy, that we're not over the sort of financial crunch of this sharp rise in interest rates?
I think that it was overplayed back in March of this year because there was a few bad apples. Now, having said that, there were very large bad apples. And so Silicon Valley Bank, for example, was a very large bank, and they behaved badly by unhedging their long duration exposure. And there are those saying that we're going to, that's not going to be a problem down the road. And that wouldn't have been a problem if the fear factors weren't there and people hadn't hit the withdrawal button on their iPhones, which is a lot quicker than lining up at the bank itself. Yes, there are some problems, and there always have been pockets of various parts of the economy and the corporate world that are behaving badly, and those who overextended themselves into a rising rate environment are paying the consequences of that. And so, yeah, there's going to be areas and dislocations, but for the most part, I'm actually, you look at the state of just demographics and the amount of wealth that's been generated over the last 15 years from quantitative easing and money printing, especially in the U.S. I think there's I don't know how much, there's trillions of dollars of money and wealth created in the U.S. Among baby boomers, and they're starting to spend that. And so for the most part, I think what's going to happen is we're going to see a widening of the gap between the wealthy and the poor, and that's going to destabilize political systems. We already are seeing that. You've got on one end of the spectrum, you've got the extreme right in the U.S. with Donald Trump, and then you actually, surprisingly, you have the extreme left with Biden, and for a capitalist type of economy, and you see that in Canada as well too, with the NDPs and the Liberals almost aligned perfectly in their philosophies and approach. And then on the other side, you have the Conservatives that some may say are kowtowing towards the right side of things. And so you have that dislocation. And so the wealthier people are kind of in the middle of that spectrum, and the poor people are looking at the extremes because the status quo isn't working.
Yeah, I've never, and again, it's strictly my opinion, but I've never seen a bigger distinction that way. And COVID certainly exemplified it. It used to drive me nuts when they said, we're all in this together. When I said, I'm certainly not, I'm choosing which house to live in. I'm fortunate to have that opportunity to have a choice. I'm not
Yeah,
sitting in a one-bedroom apartment with a child or two children with school closed or playgrounds closed. It was just, and I wasn't worried about a paycheck.
yeah,
And there was that level of uncertainty. But I think that there really was a laptop class making some decisions, and there really
yeah,
was a group. And I continue to see ignoring, even today, when we have the finance minister, Chrystia Freeland, sort of celebrating that
yeah.
inflation's down to 2.8%, when certainly everybody's running around going, which is only up 2.8. I'm trying to find something. My mortgage payment's up 30%, my food's up 9.1. I'm trying to find something that's only up 2.8. And again, who does that hurt? We know that it's moved up the income scale. It's not just the lowest quintile. Now we're into about 50% of Canadians. But I just don't see how, it just seemed to me it was insensitive to the struggles that some Canadians have been going through, continue to go through, because, while my rate of increase in costs may be slowing down, which it is, but certainly I'm still paying a big number. My cost of living is difficult. So, yeah, I
So
just think that distinction you've made is very important, and one I've never seen it to this degree in Canada anyways.
so a couple of things from that, and you bring up some really good points. First of all, looking at the inflation side of things, and we can have a separate discussion,
Yeah.
but there's the baseline effect, and so we had some pretty high levels of inflation from a year ago, and so as that becomes as we move further and further along in the months to come, it's going to be very challenging to see the same kind of level of inflation, and we'll actually start to see it go up again. And I don't think people realize that. But more so in regards to what you're talking about in regards to the disconnect between politicians and the people. What happened was with COVID, the federal government, in my opinion, has been aggressively attacking small business. It came out of the chutes calling small business tax cheats and
Oh, yeah.
everything else, and they've rapidly grown the public civil service by 40%, and no one out of the government's done the same. And then from COVID, it was used, in my opinion, used as a means to, hey, we're the government, we'll take care of you, we'll help you through that. But that kind of philosophy has been carried past now that we've gone through the worst of it, potentially, hopefully, with COVID. That same philosophy is like, well, we're going to continue to help taking care of you and implement social policies to do that. And so you have to justify the results of what you've done so far. So you have to go and cherry pick and say, well, hey, look, we told you we're going to deal with inflation, and we've dealt with it. When in reality, they may have actually made the situation worse by forcing the Bank of Canada to raise rates and running record levels of immigration when there just isn't the housing, the healthcare, and the policing and the education to support it, and they're leaving it to municipalities. Well, it's the municipalities' fault or the provincial's fault. It's not us. And so instead of, hey, let's work together. We have a problem with productivity in this country, a serious problem. Let's try and find ways to boost productivity. Let's find ways to invest in research and development. Let's try and find ways to increase self-employment, which happened in the U.S. Coming out of COVID. That's why they're stronger than we are from an economic standpoint. And then those corporations will end up hiring more people, and then you can grow your way out of that problem, because all of a sudden now you have a lot of jobs that are available for the immigration coming in, more people building houses, the economy's going that way instead of, hey, let's socially construct it ourselves by giving you the money to deal with it. And that just never works out.
One of the observations I've made, and again, it's just simply anecdotal in myself, is that we have a bigger choice right now in government than I recall. It used to be that, there was sort of overlap, conservative, liberal kind of thing, and now they've gone different directions with, clearly to me, it's climate change is the priority, not economic growth, not productivity changes, not capital investment. And that'll be a choice that Canadians have to make,
Yeah.
which side do they want? But you mentioned about the productivity, and that's a great example of, something I sit there and kind of, hey, we've got a problem here. It doesn't seem like much of the public is there, and I don't think it's a priority for government. I see no sign that it's been a priority for government.
Yeah, and so if you look at there was a recent poll that came out, I believe, that they believe the government is not following through on what most Canadians want.
Mm-hmm.
And so, but again, that comes down to this mindset by the existing government that we know better than you. If a great example was, I remember when the city took too much of my property taxes. This is a number of years ago, and they
Mm-hmm.
overbilled everybody. And there was a huge argument as to whether they should give that money back or not. And it was back to that beer and popcorn. And if
Yes.
I give the money back, they're going to spend it on beer and popcorn. Well, do you know what? That's my damn money. I'm sorry for
Yep.
swearing, but that is my money. If I want to spend it on popcorn, and movies and beer, which I don't drink, but if I did want to, I'll do it. It's my money. And so give it back. And there's that kind of mentality that we know better, and we're going to drive policy. So climate change, you don't realize it, but climate change does take a bigger priority than feeding your family, for example, because we'll feed your family. Don't worry, you can trust us. When in reality, you had 3,000 people line up in Northeast Calgary for fresh vegetables. I mean, this is crazy. You go to Vancouver, and parts of the city are completely filled with tent cities, or Nanaimo. We have a serious crisis here. You look at, I'm a big proponent of mental health. Mental health is at epic proportions following the lockdowns among children. I mean, these are things that you're even seeing it at a municipal level, where a new mayor declared a climate change emergency, when the biggest thing she can influence is housing, and removing regulations and building more houses, and helping people get off the streets. I mean, it just seems to be that really dislocation between the needs. Now, having said all of that, absolutely, we have to do something to deal with the worsening environment and warming temperatures. Absolutely. But we also have to weigh that against, the average person being able to feed their family, or get a job, or actually buy a car. And how do we do that?
It's funny, we've got another example this week with Olivia Chow, the newly elected mayor of Toronto. It's one of the first things she did is ban leaf blowers. Now, I'm not sure where that is on the list of priorities for the public there. They have similar challenges as we do across the country, especially on the housing front, which I've said many times now. I think the housing problem that we are about to experience now, Calgary's better, I mean, not to the same, anywhere near the degree that Vancouver or Toronto or Hamilton has been experiencing, Montreal. I just think it's going to blow people away, the rental crisis coming.
Yep.
We've been talking about, you can't bring in 1 million people. Actually, the plan is to bring 2 million people in plus in 3 years.
Yeah.
Well,
And
we already have a shortage of rental. We
and
know that.
people are leaving.
Yeah.
And I had a coffee with a really good friend of mine that's doing a development down in Costa Rica, and the quality of life, the social context, and everything else is that much better. So, and it's being flooded with Canadians, and those are tax dollars that are leaving, right? And that's
Yeah.
capital that could be deployed. I want to mention something, and I saw a tweet. It was really interesting, and I think this is something that government's missing. And there was some problems with government looking at phasing out oil and gas, and the perception of that, and what does that mean. But I read the other day, that in 2022, Suncor alone spent $3.1 billion on Indigenous procurement, a whopping 20% of the overall spend. By comparison, the entire federal government spent $1.5 billion from 1996 to 2018 through their Aboriginal procurement strategy, well under 1%. So if you really want to have an impact, right, on areas of the economy and areas of your civilization that is struggling, that could use it, why not support business? Why not allow business to grow and expand, and to have them partner with those areas to help solve some of those problems? You might be surprised with what happens. 1 year, they were able to double the size of what they spent from 1996 to 2018 look at the impact that's having.
Let me go further with oil just for a second and bring it down to the individual level, but the broader level there. My editorial earlier on was just talking about what did we get in return for saying no to natural gas to the degree. I know there's exceptions, but saying there's no business case on the East Coast and the Americans jump in 10 minutes later with record LNG sales to Europe, that Europe buys $1 trillion worth of LNG. I thought that was pretty good money on my, but I'm just wondering what the prospects. I look at a disconnect right now between the oil market and the paper oil market, the commodity trading market. Are you bullish on oil's prospects, or are you standing aside, or what do you think? I'm talking now as an investor.
I have never been more bullish in my career. And I ran through the bull run from 2000 through to 2014 when
Yeah.
OPEC, threw a wrench into the whole thing. And the reason why I'm very, very bullish, and I'm not a perma bull. I run a neutral strategy, so I can go 0-8 if I wanted to, and we went to almost 0-8 following 2014, and we came back in only 2 years ago, and we're really overweight. The reason being is there's been an attack by environmentalists and governments on the supply side globally. And so that's going to put at risk any sort of growth in demand or underestimated growth in demand, and which is there's quite the pervasive view that we're going to see peak demand on oil, and that's just not going to happen anytime soon, in our opinion. You just can't scale out renewables to the point that it could be disruptive. And what I mean by scale is you need to disrupt by two things: cost and convenience. You need to make life a heck of a lot more convenient for people, and you need to make it more cheaper. And that's how you scale. And renewables do neither of those. Now, I'm not saying we should ignore that. When these renewables, if you look at the project economics, they only worked for a lot of them when interest rates were really low. But let's just say inflation stays high and the cost of capital is at 4 or 5%. The economics don't work without government subsidies, and so you can't scale, and you can definitely not going to be able to scale with government subsidies. So where I'm going with that is there's not going to be the demand impact as much as what I think many are expecting, and there's going to be a greater supply impact with more than what people are expecting. And so that dislocation, all it takes is a couple, 1 or 2 million barrels a day to set the margin. And so the fundamentals will eventually catch up. People aren't counting barrels right now, but eventually you'll have to. And when that happens, you'll see a nice pop. And so we're positioned for that.
And I would think that position in Canada as part of it. I mean, I'm just looking again at our discount, our Canadian dollar. There's an oil discount too, but the Canadian dollar discount, there, that the valuations aren't there at all. We're not paying even average prices, I guess I'd say. It
Well,
looks like the cash flow's huge.
look at it this way: we get paid in US dollars, or these companies, these
Mm-hmm.
sell. So the oil price equivalent right now, the US dollar is starting to come down. The Canadian dollar is going up a little bit, but for the most part, back in the 2000s, the dollar was on par, and our cost structure is in Canadian dollars. And so we're actually making more money than we did during the previous run, and we're only getting tiny multiples on that because people think that oil prices are going to fall back to $30 or $40 a barrel, and very few are running forecasts at the curve or above the curve. And so when people have that realization that maybe these prices are going to stick around, there could be a multiple expansion as people want to get access to that cash flow. And so I think that's the position that you want to have. And you know what? As I mentioned to you at the beginning of our conversation, you want to have some inflation insurance in your portfolio and in your life. And right now it's cheap. So why don't you have a little bit of inflation protection and add a little bit of energy? You don't have to go everything all in, like so many on Twitter that will tout the energy trade. But adding a small slice. I mean, the S&P is only like 4% or five, not even
Mhm.
5%. Going up to 10 is probably not a bad idea.
Just staying with the broader market, I know this is again it's the broad question, but you look at this market, look at the valuations. What's driving this market? Do you think that we should be aware of?
So I wrote a piece in my Financial Post column about it recently, and I talk about what's really driving the markets, in particular the U.S. market and the U.S. dollar. And if you take a look at the correlation between Fed liquidity and the Fed's balance sheet and the S&P 500, it's running about 84%. So 84% of variability of the S&P can be explained by Fed liquidity. And so everyone's looking at AI, they're looking at
Hmm.
at cryptos, all of these sorts of technologies. Bottom line is, it comes down to Fed liquidity, and you can see that in March when the Fed started to reinject money back into the system with the concerns over the banking situation at that time, and the stock spiked. Now, more so right now, you have the stocks have completely removed themselves from this Fed balance sheet that's starting to start retightened again, and so either the stocks are too high, or the Fed's going to do easing again. And I don't know about you, but the economy is looking pretty strong in the U.S. So why would they start cutting rates? I know
Hmm.
inflation's coming down. What would cause them to cut rates? And if you look at it, anytime they start cutting rates, it means that there's something not good in the economy, and it's probably not a good time to own stocks. And so I am a little bit leery about some of the stocks trading at really, really, really high multiples. Now, having said that, there is a whole swath of other areas of the market that are not reflecting that kind of scenario.
I think that's a key point for people to focus on because, of course, you get sort of celebrity stocks,
Yeah,
whether it's the FANGs, the
yeah,
of those. So there's a tendency for the sort of gestalt to talk about those things.
yeah,
When you look at the broader market, there's better values there. I mean, it's interesting because I was around in 2000. And I was thinking of a story that's kind of funny. It was one of the better calls I've ever made because I wrote it in the newspaper.
mm,
And I wrote it on the date of the high of NASDAQ. And,
yeah,
it was no serious, or it was serious, but
yeah,
it wasn't like sophisticated. It was simply off the top of my head, I think 3Com owned Palm Pilot.
yeah. Oh,
Palm Pilot went public with a
yeah,
higher valuation than the parent company. And so it was that, and I went, well, wait, okay,
yeah,
now you're nuts, now you're crazy here, and but it does remind me a little bit of that with some of the valuations through the tech space, or at least the charts look very similar. It looks so exponential. So, I mean, I'm a cautious person. I'm a risk control person. I'm getting older. I would recommend that go to my children also. Control the risk. You don't have to be on every boat that leaves the dock. So I'm just saying it. I'm just wondering from your perspective, are you have some of those worries, or you think I'm just an old guy with some overwrought concerns?
Well, I was a young whippersnapper in the 2000 meltdown, but I do remember it. You had Cisco. I mean, these are
Hmm.
really good companies. So you can have something like called good companies and bad stocks. And so I think the seven, like Microsoft, great company, bad stock right now. Nvidia, good company, bad stock. And what I mean by that is, let's just take a look at Nvidia, or it's trading at 45 times sales. And so some Microsystem CEO, when it crashed and it was trading at 10 times, not 40, he said, well, investors should have known that if you're going to invest at 10 times over 10 years, you have to pay out all of your revenue every year, with assuming that there's going to be no cost of goods. You don't have to pay any of your 35,000 employees. You don't have to pay income tax, which is illegal. And you flow it all through to investors. And in the case of NVIDIA, they have to pay out 400% of their revenue. And so, I look at it and say, okay, let's put NVIDIA aside because maybe that's an air pocket, but let's look at Microsoft, 12 and a half times sales. And historically, over the last 10 years, they've been able to increase revenue by 2.5 times. Really good, by the way, for $1 trillion of size of a company to deliver
Hmm.
2.5 times revenue growth for 10 years is fantastic. Now the market's saying 12 and a half times. right?
Yeah.
And so that's to get your money back. How is that going to work? And I haven't had anybody give me an answer. If you can walk me through their capital program over the next years, next 10 years, that's going to grow their revenue by 12 and a half times, and show me where that capital is going, how it's going to do it. And so is it all going into AI, and AI is going to be exponential growth, right? I don't know. I just don't get it.
Um, I don't want to take too much of your time, but can we just give that as I know this is just sort of a broad brush, what you'd be advising individuals. You don't know their circumstances, so I appreciate that, or their age. So this is very broad brush, everyone. But
Yeah.
a flavor of what you're doing these days.
So I think most of our clients are retired or entering retirement, want to de-risk, and they've made their money through their work, through
Mm-hmm.
being an entrepreneur, being a professional, whatever the case may be. That's where you take the risk, right?
Yeah.
You're going all in on yourself and your skill set, and that's the best, highest return on investment you're going to get, is identifying the area that you're passionate about and that you're good at, and the value you can contribute, the productivity that you can add, and people will pay top dollar for that. And so that's been monetized. And so how do you transition towards more of an income approach and a conservative approach? And I'm also writing about that as well. And so the traditional way back with my parents or my parents' parents, was, well, you retire and you buy a ladder GIC, and you can just, fly down, like I mentioned, to Costa Rica and sip your margaritas, and you're off to the races. And it's supplemented and provided your lifestyle requirements. That hasn't been the case with interest rates. Maybe now the rates have come back up again, but with inflation where it's at, probably not going to cut it. So what do you do? So it's forcing people into riskier sides of the market and the traditional 60-40. And that hasn't worked either. If you look at the last 5 years, a 60-40 portfolio has only been able to generate an annualized 3% return. And so stocks have done 7.5. So do you go all in on stocks and take risk? And so we're agnostic about that. We're like, okay, what kind of rate of return do you need to meet your lifestyle? And most people
Mm-hmm.
need around a 6 or 7% in retirement, like it was back in the old days. So how do you do that? And so we structured almost like an all-weather type of portfolio, that has been able to get that kind of return or close to that return despite the ups and downs. So like that ladder GIC, a little bit more volatility. And we're doing that through a little bit of weighting to cash, which is paying you 5%. Our bonds are down to 7.5, 10% in a 60-40. So we're really underweight bonds. We're not buying the long duration risk. And thankfully that worked out well for us last year, because we didn't lose any money in bonds. Well, some bondholders lost 15%.
Yeah.
So you were told to be safe in the bonds, and you're like looking at your portfolio today and you're still down 15%. That was not very good advice. Well, then your advisor says, well, that worked for the last 35 years. It'll work again. Well, I just told you about COVID. Maybe things have changed and maybe it won't. So that's why our fixed income is down. We are big into something called structured notes. I've written about them.
Mm-hmm.
We like them. They're a hybrid between stocks and bonds. They offer a level of predictability to your portfolio, and they offer some significant downside protection. And that's about 30 to 35%. So we replace our fixed income with structured notes, and they've been really good for our clients. And
Mm-hmm.
then the rest would be 40 to 50%, 55%, a little bit of private equity, a little bit of private assets and alternatives, and then some public markets. And you have to have some exposure to that growth, some exposure to those big names in there, absolutely, even though they're trading at high levels. Maybe trim that back, look at the value segments of the market, look at some dividend stocks that are paying well. The Canadian banks are looking really good. Some of the U.S. banks have sold off. You're getting 6% dividends. Dividends have not participated with the growth segment, so maybe you look there. So that's about half your portfolio, and we find that that's worked really well, sort of an alternative all-weather 60-40 instead of that 40%. I don't know what you would call it, but we call it a goals-based risk managed return.
Well, as I was just thinking here, you've given us, normally the expression is food for thought. You've given us a banquet. And
Yeah.
I so much appreciate you finding time. And I would recommend that people can find you at M. Pelletier, CIO, on Twitter. Always a ton of good stuff to read. I do it myself and enjoy it. Martin, thanks for finding time for us. Much appreciated.
Thank you so much.